A country's banks can tell you a ton about its economic health. And right now, the story coming out of Sri Lanka's banking sector is, well, it's pretty remarkable. We're digging into a new report from First Capital Research that suggests a major comeback could be happening. So let's break down the numbers and see what's really going on. But first, why even focus on banks? Well, you can think of a country's banking sector as the heart of its economy, right? It's what pumps capital out to businesses, to consumers, and its health is one of the most direct signals we have of the nation's overall economic pulse. So let's just get right to the headline number, because it's a stunner. A 33.5% surge in profits for Sri Lanka's top banks in just 1 year. That is a massive jump that really demands an explanation. So what on earth is fueling this fire? And the title of the report itself kind of says it all: rising potential, enduring strength. That really captures the story here. The argument isn't just about a temporary rebound, but about a recovery that seems to be built on a genuinely strengthening foundation. Okay, so let's pop the hood and take a look at the engine of all this profitability. What specific parts are firing on all cylinders to produce such an impressive result? The report really boils it down to 3 key drivers. First, some steady, modest growth in their core lending business. Second, a big jump in all those fees and commissions. And then, the biggest factor of all, a massive, massive drop in the money banks have to set aside for loans they're worried might go bad. Let's start with the absolute basics: net interest income, or NII. The easiest way to think about this is like a bank's mean salary. It's the bread and butter profit they make from their fundamental job of taking in deposits and giving out loans. Now, I know what you might be thinking: 3.3% growth? That doesn't sound like a lot. But the context here is absolutely everything. The report points out that this growth happened even as interest rates were falling, which usually squeezes bank profits. So this tells us the volume of lending was strong enough to push through that headwind. Now, the second driver, this one was much more explosive: fee and commission income. You can think of this as the bank's side hustle. It grew by over 20%. This is coming directly from a rebound in the economy. More people using credit cards, more digital payments, and a big recovery in trade finance. But the real blockbuster story, the one thing that truly turbocharged profits, is right here: impairments. That's the cash banks legally have to stash away for loans that might default. And that number, it plummeted by almost 74%. This is a huge vote of confidence. It means banks believe the economy has turned a corner and that far fewer people and businesses are going to struggle to pay back their loans. Okay, so profits are absolutely booming. But is this just a sugar rush? Or is the sector actually getting healthier from the inside out? To figure that out, the report goes deep into the bank's balance sheets. And really, the best way to think about this next part is like a comprehensive health checkup for the entire banking sector. We're looking at the underlying vitals to see if this recovery is actually sustainable. And the first result from that checkup is a big one: a huge drop in the non-performing loan ratio, or NPLs. You can think of NPLs as the financial world's bad cholesterol. It's the percentage of loans that just aren't being paid back. Seeing that number fall from almost 5% to under 3% in a single year, that is a massive improvement in the sector's overall health. So what's behind this? Well, the report connects it directly to the real economy getting stronger, especially in key areas like tourism and construction. It also mentions something called parafeet execution, which is a legal process that makes it easier for banks to get their money back on defaulted loans. And that has definitely helped clean up the books. And here's the really crucial takeaway from all this: the sector isn't just healthier, it's also safer. Banks are holding on to strong levels of capital and liquidity. Think of these as financial cushions that can absorb unexpected shocks. The report confirms these cushions are way above the minimums required by regulators, giving the whole system a much more solid foundation. So we've seen strong profits and we've seen a healthier balance sheet. But what does it all mean for the future? Let's get to the report's outlook and the key takeaway for anyone watching this sector.
And this right here is really the central argument of the whole report. On one side, you have really high performance. The average return on equity, basically how much profit banks are making for their shareholders, is a very healthy 16.9%. But on the other side, you have a low valuation. The entire sector is trading for less than what it's worth on paper.
To quickly break that down, price to book value compares a company's stock market price to its actual net worth. A number under 1, like the 0.9 we see here, suggests that the market is valuing the whole sector for less than its parts are actually worth, and that can be a big sign of an undervalued asset. Now, the report doesn't just paint the whole sector with one big, broad brush. As you can see here, the analysis is actually very nuanced. Some banks, like Sampath, get a strong buy rating with a potential upside of 20%. Others, like H&B, are a hold, and NTB is even rated a sell, which suggests its recent price run might have gotten ahead of itself. But despite those individual differences, when you zoom out and look at the banking sector as a whole, the report's main conclusion is crystal clear. Based on those strong fundamentals and the attractive valuation, the analysts are sticking with their buy recommendation for the overall sector. Of course, no investment story is ever complete without looking at the potential problems, right? You have to look at the other side of the coin. So for a balanced view, what does the fine print say about the risks that are out there on the horizon? The report flags 4 key areas to keep an eye on. First, asset quality. Yeah, it's improved, but some borrowers are definitely still struggling. Second, there's always the risk of policy or political uncertainty. Third, the exchange rate can be volatile, which can hit banks with foreign currency exposure. And finally, as banking goes more digital, cybersecurity becomes a bigger and bigger threat every day. And all of this brings us right back to our central question. The data paints a very clear picture of a sector that isn't just recovering, it's thriving on healthier fundamentals and what looks like an attractive valuation. But the risks are just as real. So, is this a truly sustainable recovery, or is it just a temporary rebound? That is the multi-billion-dollar question that the market will be answering in the months ahead.